bottom line for me is gold has a total market value of about 12 trillion. If you think Bitcoin can compete against gold, I think, Steve, thinks it beats gold, but whatever, even if it competes halfway, right, it's got a 10x return from here, if not more. So I don't think that's crazy to think Bitcoin's total market value can be somewhere in the $5 to $6 trillion range. And that's a lot of upside.
This is the Valkyrie podcast. To find out more, go to valkyriefund.io.
Well, welcome to the inaugural Valkyrie Fireside Chat Series. I'm John Key. I'm one of the managing directors at Valkyrie Investments, and I'm particularly excited to be joined today by two very special friends and colleagues. My partner in crime, Steve McClurg, who is co-founder and CIO at Valkyrie Investments. And our very special guest today is Jan VanEck, CEO of VanEck Associates, also known as the man in the Bitcoin circles and community. Thanks, guys, for joining us today for this inaugural Fireside Chat.
Good to see you, John.
Thanks, John.
So this is a particularly fun call for me because I've known both of you guys for a long time. Stephen, I think you and I go back at least 10 years, maybe more. And Jan, I was trying to calculate this morning. I'm guessing about 15 that when we first met.
Probably could be, yeah.
Yeah. So
I was just starting my career.
Hey, man, that was my line. You can't. But yeah, time flies, and it's great that we're all here together, still kind of innovating and doing new things. So great to have you. I think the listeners will enjoy the provocative conversation, the interesting conversation from two thought leaders in the Bitcoin space. Our main topic for today, or sort of the general core of the theme of this chat, is going to be around the Bitcoin ETFs, which is near and dear to all of our hearts, and why it's important, why we think it's a benefit for all investors to have a Bitcoin ETF available for them to access the Bitcoin asset class, and what the prospects may be for the SEC approval, within, who knows, a year, 2 years, maybe longer, maybe shorter. We don't know, but I'd love to hear your thoughts on that. But before we get into all of that, just like to take maybe a half a step back and ask the two of you how you made your way into the world of digital assets, cryptocurrencies, Bitcoin. Jan, you come from a little bit of a different, more traditional asset management perspective, $70 billion asset manager, plus or minus. I think about 40 billion or so is in actual ETF in the ETF side.
Yeah. We're about 90% ETFs now. Yeah.
90%. Okay.
Yeah. If you include the US.
Terrific. And Stephen, you come at it from a little bit of a different angle, having worked at Guggenheim and having, a lot of experience in designing and structuring investment solutions around esoteric asset classes that were unique, to investors and provided access. So coming from these two different perspectives, love to hear your guys' thoughts on how you got into crypto, why it was interesting and exciting for you, and kind of what got you engaged and committed to this asset class. Jan, maybe I'll start with you.
Sure. It was really a two-step process. One is someone's got to mention it to you, right? And several different sources. A venture capital friend of mine started talking about it, I guess probably 2015 or so. My oldest son started dabbling in it around the same time period. And actually there was a parent at one of my kids' schools who just was super enthusiastic about this thing that no one knew what he was talking about. And I was kind of one of the parents that would stay behind after the boring parent meeting and listen to him. And to be honest, at first it was just I was a little disturbed, but anyway, I think the second step is probably the more important process, where it said, listen, is this going to have a future? And so in early 2017, just tried to do my own deep dive because none of my colleagues were particularly knowledgeable about it, and just did as much reading online and listening to podcasts as I could. And that was it. And I basically said, listen, in history we're known for starting the first gold fund in the US. There have been competitors to gold, right? Silver, platinum. And so I said, well, why couldn't this be a competitor to gold? And I thought, maybe it won't be a very successful competitor, but it's going to be a competitor. And clients of ours, investors in gold, were talking about it. So that was a confirmation as well. But it was still, kind of that, is it a fad or is it a sustainable trend? And so that hit that in early 2017.
So you recognized early on that this was sort of a competitor, or maybe an alternative to gold as a store of value, as a hedge, as an inflation hedge. You saw that early on, given your background with gold in particular.
Yeah, I mean, I think that was the initial appeal.
Right. Stephen, how about you?
I think what's interesting is we truly do come at it from different angles. I actually never saw it as something more similar to gold. You may not know this, John, but before I joined Guggenheim, I had taken a break from traditional finance and worked at Electronic Arts, the video game company, for a couple of years. And during that time, there was a major growth in digital currencies within video gaming platforms. And this is pre-2009 that I was there. And I really saw it as a thing. And if you remember, the iPhone came out in 2007, and I was part of the team that was building the iPhone game division at Electronic Arts. And we really focused on digital currencies for use inside of games. And we just saw this explosion taking place. And by the way, we were late to the game in the US. It was even bigger in places like South Korea and Japan, where prior to 2007, prior to the iPhone, phones were already, mostly being used for consumer purposes in those two countries. So they were 5 years ahead of the rest of the world in digital currencies. And I say digital currencies because you can't transact on a lot of these video game platforms without it. And by the time that Bitcoin, or by the time that I discovered Bitcoin, I was already at Guggenheim. I was involved in trading and analyzing sovereign credit, emerging market debt, foreign currencies, and I saw it more as a digital foreign currency, something to be used for borderless transactions, peer-to-peer. But the most interesting feature was its limited supply, which most currencies obviously don't have a limited supply. And frankly, the first time I dug into it, I want to say it was end of 2009, 2010. I thought that the Fed would shut it down. I didn't think there was much hope in the U.S., but I thought it was a pretty interesting prospect for emerging market countries, transferring money across borders. It wasn't until a bit later that I really kind of stepped in, and that was 2016 when I left traditional finance again to go into fintech, and that's really where I was. I spent a lot of time there, but I see it, I see it a little, slightly differently, but I see it as it's a very useful currency that can be used, for global transactions.
Yeah, I knew you were at Electronic Arts and you had taken a break. I didn't realize there was a whole connection to the Bitcoin and gaming and all that. That's interesting perspective. Well, VanEck and Valkyrie, as it stands today, are the only two firms that have filed for an ETF. Jan, you've had a couple of filings, 17 and 18, that ultimately, sort of hung around on the vine for a bit, and I guess you guys pulled them, and then you refiled at the end of last year, and then Valkyrie filed this year. What do you guys see that has changed, perhaps in the last 3 or 4 years, that give you comfort that there is sort of a new paradigm, maybe a new opportunity, that the SEC has now gotten more comfortable, perhaps? Maybe it's allowed the industry to work out some of its kinks where it didn't have to regulate it, just sort of let the the industry take care of itself a little bit. And then, with a new head of an SEC, Gary Gensler, who has a background in blockchain, ironically, from being a professor at MIT for a while. Is this sort of a confluence point where things are now going to be looked at a little bit differently than, say, 3 years ago? Or do you still see sort of a longer path to finally getting some kind of an approval for an ETF? Stephen, we can go ahead, Jan.
Yeah, well, John, I don't think I don't know the answer, but let me give you a couple of things to think about. First of all, obviously, the Bitcoin community has grown dramatically because not only have millions of individual investors started buying Bitcoin. I think Coinbase has somewhere like 40 million clients, and I assume all of them own some Bitcoin as well as other coins. But it's gone mainstream in terms of transaction platforms like Square's Cash App, PayPal, and BlockFi is going to offer Bitcoin credits when you use a major credit card sometime here in 2021. And then lastly, in terms of adoption, Canada approved a Bitcoin retail fund in 2020. And, now even in mainland Europe, not just Sweden and Switzerland, but also in the continent, you have a Bitcoin access product, and we have one of those. So overall, just the demand and the ecosystem has grown from the retail level. Then you have institutions like MassMutual, MicroStrategy joining. But as to the SEC's concerns, the custody technology, if you will, has really not changed very much, but we have some more established providers. Fidelity has lent their name and capital to becoming a digital assets custodian, which I think is positive for the space. And then you've seen Coinbase purchasing Zappo, and they're offering obviously institutional level custody as well, and they filed to go public. So again, more prominence to the firms that are offering the custody solutions. And last, there's this interesting issue of the price manipulation or market manipulation, and the way the industry is addressing that so far is by using indices and pricing mechanisms from pretty much regulated entities. And so I think the price of almost anything can be manipulated by nefarious people. So one can't make the case that Bitcoin is unmanipulable, but almost every asset is manipulable. So depending on how the SEC applies that standard, we are certainly very comfortable in offering products, to all kinds of investors using those sources.
Yeah. Yeah, for us, what I've really seen is probably two of the things that you just mentioned, Jan, and it's really regulators' comfort around custody and security, as well as price manipulation. And as the community grows, as the market cap grows, price manipulation is much harder to accomplish. As you mentioned, anything can be manipulated. But the larger it is, the harder it is to manipulate, because it takes more capital to manipulate those markets, so to speak. It's the reason why it's very difficult to create ETFs that hold micro cap OTC traded equities. They're thinly traded, they're very illiquid, easy to manipulate, and there's certainly rules around inclusion of those types of equities in ETFs, and as there should be rules around other assets that are thinly traded. But as adoption grows, that certainly changes. Custody and security is probably the biggest point that we've noticed a difference in. Jim and I just had an announcement today that they have SOC 1, SOC 2 compliance, that they're looking and feeling a whole lot more like a traditional third-party custody solution. When you're trading, when you're a traditional asset manager and you're trading securities, you just know that your third-party custody solution, whether it's one of the big players like State Street or Bank of New York, that when you own those securities on behalf of your clients, that they're not going to be stolen, If the bank goes bankrupt, the third-party custody solution is bankrupt remote, so it can't be accessed. It belongs to the clients. You have reports every day. These are the things that traditional asset managers as well as institutional investors are used to seeing and used to dealing with. Shops like Gemini and Coinbase and even Fidelity, they feel very institutional. Of course, Fidelity does, but Coinbase and Gemini have made a lot of progress to feel a lot more institutional. Coinbase, you mentioned the purchase of Zappo. That's very important, but also the team from Tagomi, that was another acquisition, and then the build out of Coinbase's institutional side of the business. It's run by a former prime brokerage person from Barclays. It has a lot of people from the traditional prime brokerage, custody and trading space, and they do feel very, very institutional. The security has stepped up in the last 6 months. The platforms have stepped up in the last 6 months, and I feel like both traders and asset managers as well as regulators are getting much more comfortable with those solutions, which leads me to believe that that's just two more ticks to get us closer to an approved product.
You guys talked a lot about sort of mainstreaming and bigger players coming in. This recent rally, we've seen a couple of the indices, because of the amount of demand coming in, and some challenges with regard to handling that demand. How do you think that affects the SEC's view on capacity and trading and volume and price discovery and things like that? These are growing pains and it's normal. We get it. But do you think that also creates another hurdle for the SEC to get comfortable as some of these other things are maturing?
I think continued education is really important. We're certainly committing to be a part of that continued education, whether it's bringing up and showing our analysis of the custody solutions that are out there, analysis of trading volume, who's in, who's doing what, where it's trading around the world. But we also have a slightly different committee as well that we're going to have to engage in and speak with, and we'll have to see where the staff stands once things have moved around a little bit with the new administration.
I mean, John, I flip it around and say that's even more of the reason, if any crypto exchange itself has operating problems because of volume, online brokers do too, right? It's not unknown. But that's more of a reason, to approve a Bitcoin ETF, right? That trades on a regulated exchange that has just a higher degree of reliability, right? So it's much less likely that the New York Stock Exchange, NASDAQ, or SIBO go down than, Coinbase. So just given the regulatory capital and technology tests that they have to meet, but that's a reason to approve an ETF, right? Not to shy away from it. But look, I think a lot of it's political too. So we just can't take away that element of the SEC at some level had no basis for declining a Bitcoin ETF because no product is perfect. But the whole point is you disclose it, and in America, you let the investors decide whether they want to participate or not. And having tens of millions of people participate in an unregulated system compared to a regulated system, I think that's a kind of an easy policy choice, but they chose to come to the opposite conclusion.
Do you guys view Gensler as a friendly appointment as chairman of the SEC? Do you think his background with blockchain and what he's been doing at MIT and sort of at least he understands the nuts and bolts of this thing, so maybe it doesn't scare him like it may have others? Do you think that's a positive?
I really don't know him at all. I would say that the CFTC is used to, he spent most of his time regulating swaps, is my understanding, but they do understand how different assets work very differently, right? And they did allow the green lighting of Bitcoin futures several years ago now, right? So one would hope that yes, he might be more positively disposed, but I don't know. We'll see. I think his voice will be important. Let me put it that way.
Yeah, and by the way, I actually, this is going to be contrary to a lot of other people believe, but I didn't feel like Chairman Clayton was necessarily against blockchain or against Bitcoin, and I also felt like interactions that I've had with the staff, even 2 years ago, the staff is pretty knowledgeable in blockchain, and it was quite surprising, talking about Bitcoin and blockchain and the types of questions they asked. It definitely wasn't a place of ignorance. It was certainly a place of a ton of research had happened and a ton of knowledge. So I'm with you. I don't know what direction he's going to go in, but I certainly feel like the rest of the staff are probably continuing to move forward.
I mean, broadly, John, I would just throw on the agenda, and I know we care about an ETF, but what do the regulators posture towards developing a decentralized finance industry in the United States? I mean, New York State has sued some offshore exchanges. I think they've been sort of pretty hostile. BlockFi is a company that offers the ability to custody Bitcoin and earn interest on it, but you can't do it in New York State if you're a New York State resident. And they'll track down your cell phone to see where you are exactly. So that's not very hospitable to developing the whole industry. So, federal regulation of securities laws has made the U.S. capital markets more efficient, I'd say. I'd say that, it's still an open question. The regulators are more informed about the crypto universe, but most of the development's happening outside the United States and the innovation, and it's happening very, very quickly. So we'll just have to see what their view is on that. I think that's really important.
Yeah. Great. On that question, actually, what is, since you brought it up, Jan, what is your views generally on sort of this decentralized finance movement, whether it starts to gain some traction? Do you see sort of stablecoin currency developments? I think China is working on one now. Obviously, all the U.S. banks, I'm sure, are kind of looking into all of these issues. Since you brought that up, what is both your guys' views on where that is from a development standpoint?
I'll give you my quick view, which is in 2017, I think stuff was being traded, but this whole idea of a smart contract, Ethereum and everything was more a theory without, proven applications. And now fast forward 3 years, it's amazing the amount of development that's happened in that ecosystem. Really, and I say the breakthrough things to me are, number one, that you can earn interest on Bitcoin, because when you can earn interest like 6%, 10% interest on an asset, and you have negative interest rates in Europe and low interest rates in the United States, that's going to attract capital, number one. And just the infrastructure, the technology infrastructure of smart contracts, meaning they're building up reliable data reference points. So if Steve agrees to buy something from me in 2 months, we won't be fighting about what the price of Bitcoin is at that point. There are companies that are offering those trusted third-party data solutions. And so, I mean, to me, I think I'm way more optimistic that this is an ecosystem with millions of investors, billions of dollars of, monthly transaction volume, and an explosion of the number of instruments that are available. One of the crypto exchanges actually has listed not just 2 of our ETFs, which I think is interesting in and of itself, but they launched, it's FTX, launched a kind of version of the price of Coinbase, which hasn't gone public yet, and they didn't have access to the shares, but they created a prediction market around what the price of the stock would be. I mean, that's attracting capital, that's attracting investors, and that's what I'm saying. That's where I'm concerned that, the U.S. is obsessing so much and not trying to create more safe space. Now, having said that, some of the things the SEC did recently by allowing broker dealers to custody within a safe harbor some digital assets in December, I consider that a glass half full move. Because I think traditional broker dealers are extremely nervous. That's part of the reason we're doing this call, right? They're so nervous about the whole space. I think at least saying the SEC saying you can do this in this area, okay, you have to have bells and whistles, but I think that's super positive. So I'm really encouraged by that.
Yeah. It was actually smart contracts that attracted me to blockchain before Bitcoin did. I was aware of Bitcoin, but I didn't buy it until much later. But the whole promise of smart contracts on blockchain really got me interested in the ability to essentially tokenize bonds. If you follow me on that line of thinking, because bonds are a very clunky instrument. I remember, I think it was 2010. A software came out called Market Access that allowed you to actually trade. As a institutional bond trader, you're able to trade smaller lots of bonds for your portfolios, and it sort of worked. But what ended up happening is you would put out an order to buy, and then all the same guys that you already knew from the street would call you on the phone and execute the trade with you. So it wasn't as automatic as everybody had hoped, but at least you got your price out there, to multiple people at once, and then of course it allows people to run up the price if they start seeing it. But really, what blockchain, specifically smart contracts, could allow you to do is, people that are in bonds, they know that every bond is different. It could be the same company issuing a different bond every year, and you would think, oh, it's kind of like equities, it's all the same. No, the bond debentures are different every single time. They might have different covenants. They might have different rights to your investors, and some of the smaller, whether it's companies or sovereign nations that are issuing bonds below the $1 billion benchmark, they have a hard time distributing it because the large benchmark players like the PIMCOs and the BlackRocks of the world simply can't buy a whole lot of things that are outside of the benchmark. So what's really interesting to me, for again, smaller sovereign countries, municipalities, smaller corporations that want to issue bonds that might be even high quality, this is a technology that allows you to program those covenants, make it a little bit less clunky, and even program the trading and divide up the lots so that people can buy it. If you're living in a municipality, like, let's say, live in Arizona, and there's a water and power company that wants to issue bonds, and it's only 100 million. Nobody else is really going to care about it, but the people that live in the community might care about it, and they might want to fund their own projects and earn interest on those projects. And it's even more important for states that have high income taxes, where you can get a tax advantage for owning the bonds of your own state. You can buy it directly instead of going through several intermediaries. But that's really, for me, that's what opened up my eyes and got me excited about it.
Yeah, that would be a very cool application, particularly in California and New York, high tax states, right?
That's exactly.
Yeah. I'm just going to, Jan, I'm going to give you a shameless plug here. Some of the comments that you're making can be found in your latest post called "The Latest on Bitcoin Without the Jargon," which for a beginner like me was enjoyable to read. But I did have something circled here, and I think you guys have touched on it, but I just want to read it real quickly because I think it touches on this issue about addressing gaps in Wall Street and how smart contracts can help there. And if I'm reading the wrong section, Jan, you can sort of correct me after I read it. or if I'm missing the point. It says, now there's been progress in the build out of an independent, reliable data infrastructure to support smart contracts. Remember, using the if logic in finance usually refers to a price. Well, that price better be reliable. And data problems are rife on Wall Street. This data infrastructure isn't fully proven, but a lot of important progress has been made. Firms valued in the billions of dollars are directly addressing this problem. And I think that goes to what both of you were saying in terms of how the use case can be made here, and also addressing this sort of gap that's inherent in Wall Street with data, which I think is a really important point, which again, you guys sort of addressed, but maybe not as directly. So if you have any thoughts on that to add, please feel free. But I thought that was a kind of a telling little blurb within the post here.
Yeah, it's what I was talking about before in my example with, Steve agrees to buy something from me in 2 months at the market price. Well, what's the market price then? And so, look, I think one of the great things is there's a ton of transparency, compared to the bond market that we're obviously all familiar with, which is completely opaque, and people have incentives to keep it opaque. That is not the ethos of crypto. I think if there is confusion or lack of transparency, those projects don't work, those exchanges don't get volume, because word of mouth on Reddit and on the internet, travels super fast. So you have to earn your brand. But yeah, I mean, Chainlink and Polkadot were the companies that I had in mind there, and that's what they're doing is they're building that technology that allows the use of reference prices in contracts, and that contract could be anywhere. It could be on a different exchange. It's just the ecosystem that could leverage the use of that. So, yeah, it's just the development is happening super fast. That's my point. Now, we're sitting here in January, right, 2021. The valuations on these companies after the run up in the last month or two is ridiculous, right? So it's almost like all growth companies around the world, and I'm not pounding the table to say buy these tokens by any means. I'm just really talking about, in fact, on the contrary. So I'm not short them, but I'm certainly not buying them at these prices. But it's just more the point of how far these projects and these companies are moving, and it's like real stuff with real money. So that's really that's the development, John, that I think is so different now. And another way of saying it is, look, Bitcoin is not the same when its market cap is 10 million as when its market cap is 100 million, or today where it's $500 billion. It's just a much bigger, more robust ecosystem with a lot more miners, developers. The whole thing is stronger. And so I think you'll see that in the price movement, but I think DeFi is part of that, decentralized finance.
Yeah.
Great. Switching gears a little bit, many have labeled Bitcoin as digital gold, and some may agree and some may disagree with that labeling. I guess the question to you guys is, can or should an investor own both Bitcoin and gold in their portfolios? Can they reside harmoniously together, or is it a one or the other kind of a decision for investors to make? Both have similar qualities and characteristics, as we know, which is maybe a little bit why these are overlapping in terms of perhaps living together. But is gold still a viable asset? Can and should Bitcoin and gold be owned at the same time, or should I own one or the other? And Stephen, maybe I'll toss this one to you first.
Great. Yeah. Toss it to the guy that knows the least about it, and then let the expert chime in.
Well, Jan is unique. Jan is uniquely qualified because he has both the gold history with VanEck and now the Bitcoin history. But I know you have a view in terms of whether or not gold is even still a good store of value, which we can discuss. But I thought.
Yeah, no, I do have an opinion, and I can't wait to hear Jan's after this, because his is probably the right opinion. But Look, I don't think that they're the same thing. I know that's a narrative that was sort of created, that Bitcoin is digital gold. And sure, I guess it is, as long as people see it that way and perceive it as a store of value. I really perceive it in two ways. One of them is, at the moment, I see it as a speculative, it's a speculative instrument, right? That, people are speculating on its growth and on its price. But what we'll ultimately get to is a place to where it's actually quite useful. And as long as there's a lot of speculation on it, the use cases are a little bit lower. But when there's less speculation and less volatility, the use cases sort of go up, right? So when prices are more stable on a currency, people tend to spend it. When prices are volatile, people either try to dump it or hold it. Which is sometimes in different cycles the case of Bitcoin, but it needs that speculation to grow to a size into a market cap so that it can be distributed widely enough to where it is a useful global peer-to-peer digital currency. As far as in a portfolio, whether you hold gold or Bitcoin, I truly don't think it's an either or. Obviously everybody's portfolio and everybody's investment objectives are different, but I actually don't really see a place for gold in a portfolio anymore, or I should say I see a lower need for it, and here's the reason why. There was a lot of speculation back in 2009, even into 2010. That there would be a ton of inflation due to money printing and due to lower interest rates. And if you're a Keynesian, you believe that inflation will always come, but it might take a very long period of time. And a lot of people, including myself, speculated that gold would go up in value pretty drastically with the inflation that was coming from low rates. And it really didn't happen like we thought. And even now, in the last year, with all the money printing, and by the way, 10 years ago, a lot of countries were buying gold to hold on in their foreign currency reserves during the Great Recession, because the U.S. was printing dollars, Japan was printing dollars, Euro was printing dollars. It's like, okay, well, what do? Well, you got to hold a certain amount of securities that are issued by those countries, but gold is also a safer bet if those currencies depreciate in value. This time around, we haven't seen central banks hoarding or buying gold like they did 10 years ago, and I think it's an attitude of realizing that, well, it's not really gold that you want; it's the currencies of these countries that are printing them, especially the U.S. If an emerging market country wants to be competitive in exports, then they have to buy currencies they have to buy U.S. dollar and U.S. dollar securities onto their balance sheet in order to manipulate their own currency to the level that the U.S. is, just to match them in price so that they can be competitive export-wise. So gold really hasn't entered the picture like it did 10 years ago. So that's why I kind of see its luster fading. I don't think it goes away, but it's not something that I personally want to speculate on. Bitcoin, like I said, I do see it as something that's a little bit different and unique. I see it as a currency that can't be overprinted. That's a good hedge against printing of currencies globally. And now my portfolio is going to be way different than anybody else's, and it's probably very heavy in Bitcoin versus anything else. But I would recommend anybody holding somewhere between 2 and 5% in Bitcoin, whereas I probably wouldn't make the same recommendation on gold.
Well, we're in that environment with massive capital being printed and low interest rates, and clearly some upside to the Bitcoin trade is as a result of people believing that the devaluation is and the impending inflation is around the corner. But I get your point. Jan, your thoughts?
Sure. Well, listen, I think gold, this is an oversimplification, but gold trades against real interest rates. And the cycles recently where you have negative real rates, which means that you're kind of losing money in the bank, right? Like, so let's say that inflation is 2% and the bank is paying you 0.5%, then you're losing 1.5% of value every year. That's good for gold, right? That's what drove gold to all-time highs last year. But the negative real interest rates, 1.5%, that's not like it was in the 1970s. In the 1970s, the bank gave you 5%, but inflation was 10%. So you were losing 5% a year. And that's what leads to the really big gold bull markets, is really negative real rates of much higher numbers than what you've seen recently. I actually, I agree with Steve. I think this last cycle around the global financial crisis and what we're experiencing now is relatively similar. There are negative real rates, but they're not driving gold to crazy high appreciation numbers. We called for a little bit higher rates here in 2021, which is a little bit of headwinds against gold. Having said that, investors have different objectives. And I do think in a negative real interest rate environment, or it's this low interest rate environment, what they call the 60-40, right? The 40% of your portfolio is broken. And I've spoken to a lot of institutional investors, and they know that the downside with gold bullion, it's a big market, super liquid, is much less than it is with Bitcoin. Now, it's just a fact of where Bitcoin is now, that its price volatility is just much higher than bullion. So for them, they want gold. It really kind of depends on your personal risk profile, like Steve was saying. So Bitcoin also has the similarities with gold, the limited supply. And I will call it, for argument's sake, no income, right? So you have the investors like Warren Buffett saying, I never own Bitcoin because I never own gold because these assets don't provide me income. Let's put aside whether you can earn income off of Bitcoin or not, because you can in certain ways today, but it wasn't really designed that way. So that's the similarities with gold. I call Bitcoin it trades like 2/3 of tech stock and 1/3 of store of value, right? So I guess I agree with Steve. I think that if I'm right about the store of value, then you should own some along with your gold, and whatever you want to, especially in this era of huge stimulus, you definitely want to own some now at this point in the cycle. The question is, if you're a big believer in what I call this new financial, the crypto Wall Street, really putting a threat as a disruptor of traditional banks, then you want to own more, because your old bank, your banks with branches and all that, just not going to be that profitable going forward. And fintech is going after every profit center, right? So if they make a lot of money on FX, everyone's going to go and try to disintermediate them. So over a 5-year period, you'd want to own as much money as you have in financials in your portfolio. So whatever that used to be of the S&P, say that 5 or 10%, I would argue Bitcoin is a proxy for disrupting traditional financial services. So that for that reason, I'd own more.
Well, that's an interesting perspective, obviously, because players like PayPal and Square, who are fintech disruptors and are now, kind of actively getting into the Bitcoin market. And I don't know about Square, but from what I'm reading, since PayPal has entered and opened up to Bitcoin, that they have been among the most active buyers in the marketplace through their channel, through their platform. So clearly that's, the fintech story and the disintermediation of traditional banks and their value and their business is being attacked at 3 or 4 different ways. And so I would agree with you that, that whatever you may look at for your traditional JP Morgan, Citibank, whatever, perhaps, as a proxy for now, PayPal, Square, and some of the others and some of the other fintechs could be, part of that equation. And then over time, it evolves perhaps into your full Bitcoin allocation as your proxy. Interesting point.
I think, John, I don't know what your reaction to this is, but I find a lot of investors, look, they dismiss it and don't want to research it. But then also they pay attention every time it has a parabolic price increase.
Oh, you mean like CNBC, who
Right.
kind of took it off the air for a year and a half, and now all of a sudden it's all they talk about, and now it's on the ticker line. Yes.
And so I think that actually the difficult thing is this sort of stupid concept of like dollar cost averaging, and it's just because the emotional hurdle around Bitcoin is way bigger than other investments. Like I could say, hey, buy this China tech stock, and you kind of say, okay, how much? Bitcoin. Oh no, Bitcoin, can't buy Bitcoin. It's too late. It's too early. I'm like, so the biggest hurdle is just buy a little. Like I'm kind of with, Steve or Rick Allen anyway, like 1% is like the minimum, right? So, but don't buy 1% of your portfolio, buy a fraction of a percent. So you're in it. And if it goes down, you're happy because you can buy more at a lower price. Right. And it goes lower, you can buy a little bit more. So until you get to that 1%, and even 1%, if it went to zero, is that really going to change your life? No. So I think that the biggest thing that I see is just people having the psychological issue around buying Bitcoin. Not so much, just getting involved in it. Let me put it that way.
Yeah.
Yeah. I used to tell people that, if you wanted to get, and this was 4 or 5 years ago, if you want to buy Bitcoin, imagine how much you would spend going to Vegas on the craps table, or how much are you willing to spend in Vegas one night? Gamble, take that money, put it in, and forget about it for a little bit.
In other words, in my case, what am I willing to lose that night?
Absolutely.
Right.
Absolutely. Now my opinion has changed a lot in the last 5 years, but then, that's sort of like, okay, something could happen then. By the way, it's funny that you bring up, most people dismiss it because that was my initial reaction. I did a little bit of research and then I dismissed it. I thought that there's no central bank in the world that's going to allow this thing to exist, particularly the Fed. And sure enough, it's become bigger than that. And then I didn't look at the big pops. I always looked at, there's another fraud. There's another exchange that went down. There's another dip, because I'm a natural pessimist. So that was me, backing up my assumption. And then of course,
so Steve, so let's assume that Bitcoin hit a temporary top here at 41,000. How low do you think it corrects this time? In 2013 and 2017, I think it fell about 80% each time.
Yeah, that's a good question. I've been looking at about 30,000 since it hit 40, and we're in the 30 context right now. We'll see if it goes any lower, but I think that there's ample demand at this level to support it here. I really do. There's a lot of people that missed it going right through 30, and they're kind of backing up the truck now that it's back at the level that they want. So I don't know if it'll ever go back below 25, but who knows, right? People are fickle.
Well, it's a 50-day moving average is about 24,000, and its 250-day moving average is 13,500. But my fear is just what you're saying, that a lot of people have a lot of appetite to get invested around 30,000. Yeah. So it may not go back down there, which would be disappointing to me.
Yeah, I'd like to buy more at a lower level for sure.
I think it's a lot. Let me I don't think this is provocative, but I don't think in 2017, I actually wrote it could go down 80% this time. At this time, I do not think it can go down 80%. I think, 250-day moving average, 13,500 is, I think so many people would be buying at those levels. Of course, there'll be a lot of sellers too, right? There'll be a lot of fear in the market and all that kind of stuff, but I just think it's a different thing than it was. It's just maturing as an asset.
Yeah, I do too. I was in 2017, I was very fearful when it was going up as fast as it did and hit 20,000. It was almost obvious that it was going to drop 80% then, right? It felt very bubbly. It was just people just wildly speculating. Now it's definitely a different group of people that are in now.
And to me, I mean, I'm not a technician, but hitting all-time highs in 2020 for Bitcoin, I think was a breakthrough, right? Because it was it was easy for people to say, oh, it's a bubble. Yes, it was parabolic rise. Yes, taxi drivers and your kids were buying it or whatever you want to, your mother-in-law, whatever your favorite straw man is. But with all-time highs, I think you can't make that argument anymore. Assets, bubbles don't, tulips went up once and they came down, right? They didn't go back up and make new all-time highs. It wasn't that kind of a price chart. And so I just don't think I think you're at a different level.
Yeah. I mean, in even use cases being up to where they are, there's so many companies that accept Bitcoin as payment now. And there's transactions between real companies. Real companies are holding Bitcoin on their balance sheets. Why? Because not because Bitcoin's going up, but because the dollar is going down. We've seen unprecedented money printing in the last year, and we'll probably see it again over the next year. That's a fundamental reason.
Yeah.
Yeah, it's become a confidence game, I guess, right?
Yeah.
Speaking of which, and this is a little bit, tangential, but talk to us a little bit about halving when it halves, and what that means to the current rally. I guess it's every 4 years, right? We had a halving happen in May of this year. It seems that every time a halving occurs, we have this rally, 16 into 17 and so on. What is the implications of halvings? And, we've talked a little bit about broader investor acceptance. Paul Tudor Jones and Druckenmiller and all these sort of notable name guys are now kind of lending credibility to this thing, right? So like we're all talking about in 17, 16, we thought it was a fad. We were a little bit suspect. We didn't have that confidence, right? Today, it's become more of a confidence game. And you've got people who we trust generally, like yourselves, the two of you, and the folks that we mentioned, Michael Saylor at MicroStrategy, as you mentioned, Stephen, companies putting large amounts of their capital into Bitcoin. I mean, these are real kind of legitimate investments, and it's kind of taken on a different tone to the whole thing. So I guess, how would you you've already sort of touched on it, but with all the concern with central banks and everything else that's going on, how would you say this market rally from 5,800 back in March of last year to the 4,200 top, how much of it is driven by any of these factors, and how important do these factors become going forward? I think what I'm hearing you all say is all these dynamics are going to prevent the 80% drop next time around.
Yeah, there are not a lot of theories of the Bitcoin price movement. Probably the most, I would say the most respectable there's an anonymous commentator on Bitcoin called Plan B. And if you want to listen to what he says about the halvings and the stock, he has what he calls a stock to flow model, which basically says, if there's fewer Bitcoin being produced every year, the value should go up, right? And that, he did that again. He studied that against gold. So if you want to listen to him, Stefan Livera, Livera, has a podcast where he interviews Plan B. He's got 3 interviews out there. The one this spring, I think, is the best one. But anyway, so I think, having said that, I think it's like any asset. There's fear and there's greed. I think hopefully we're moving from the greed mode to the fear, and I think there will be price volatility around it, John, no matter these other investors that are involved now. But I don't think the correction will be as much. Yeah, I guess I'll agree with you on that note.
Yeah.
Stephen, do you still look at this as a speculative asset class? Would you still consider this as sort of a speculative trade?
I think any trade obviously is speculative. And this is a trade that is probably more speculative than others, but the speculation is slowly coming out. As Jan just mentioned, it's become more of a fear trade. Fear of you know, walking around with wheelbarrows full of Deutschmarks trying to buy bread. You know, I think people generally think about things like that, and the fear is driving people to buy more sound money, and I see this as slightly more sound money. It's than what a lot of other you know, banks are producing at the moment. You know, Janet Yellen came out today and said that you know, one of her goals as a Treasury Secretary was going to try to prevent other countries from being, you know, currency manipulators. So there's going to be a real focus on that, and there's going to be a focus on also printing money to, you know, pay for all the bills that we have with new bills that are going to be passed this year, and that truly is driving people to that fear trade, to, you know, a little bit less speculation, a little bit more. Let's find something that's going to be a useful currency that can't be manipulated as much as other ones.
Yeah,
Well, guys, we're sort of. I'm sorry. Go ahead, Young.
You know, Jack, I think the bottom line for me is gold has a total market value of about 12 trillion. You know, if you think Bitcoin can compete against gold, I think, you know, Steve, I think thinks it beats gold, but whatever, even if it competes halfway, right, it's got a 10x return from here, if not more. So I don't think that's crazy to think Bitcoin's total market value can be somewhere in the $5 to $6 trillion range, and that's a lot of upside. So it's people think, well, it's volatile, therefore it's speculative. But I think, you know, it's like any growth company. If it can get there, given what it's, you know, the total addressable market, as they say, right? Given what role it could play in the world, it's got a long ways to go potentially. Look, it could go to zero. I'm not saying it couldn't, but it's kind of where it's at now. It's kind of in a nowhere's land in a way to me, because if this is going to be real, it's going to be worth a lot more money.
Right.
You know,
That's right.
There's no reason for it not to be. And so that's what's blindingly obvious. You may disagree to the conclusion, but if the conclusion is right, that it can be the gold of the internet, as long as the money of the internet, as long as the internet is around, and it may not be, but as long as it's around, there's no reason why Bitcoin can't have a market cap of much higher than it is now.
Yep.
Question of
I agree with that.
Question of adoption, time, and uses.
Yep, exactly right.
All right, guys. We are kind of nearing the end of our hour. I want to thank both of you for sharing your thoughts, your perspectives, for taking the time to talk to us today. I've learned a lot. It's been a lot of fun having you guys on the call. Last word from each of you with Jan, I think you were sort of predicting a price of around 350K. Is that what your 10X from here gets you to?
Yeah, a little bit higher. I mean, look at, yeah, I think the total market cap can be to 5 to 6 trillion.
5 to 6 trillion. Stephen?
Half of gold.
Yeah, I mean, my projection's been 500,000. In the short run, I think we're going to see something like, 100. And when I say short run, 9 to 18 months from now, if not sooner. But I think there's no reason why we couldn't see 500,000.
Okay. Well, we'll let that be the last word.
Thanks, John.
Guys. Enjoy it. We've enjoyed it, and we'll see you guys on the next Fireside Chat. Stephen, you and I will probably be there. John, thanks again for joining us.
All right, John. And the next time you're wearing an Islanders hat, right?
I'll put on an Islanders hat. Well, I'm going to get one of those cool Hodler hats or a Bitcoin hat or something. I gotta kind of update my garb, I guess, for these calls.
Get you a honey badger hat.
Badger.
Thanks for listening. Drop us a line and say hello on Twitter or LinkedIn. Have a great day. This is not financial or legal advice. Always do your own research.